All right, we are up to lesson 3, the income statement, in this financial accounting series. The learning objectives, we're first going to describe the operating cycle and the concepts of cash versus accrual accounting. We're going to define revenues, expenses, and net income. We are going to prepare journal entries for income statement accounts and then use those journal entries to prepare an income statement and compute earnings per share. So let's start with an example, and this is Amazon. So we can take a peek at Amazon's income statement here, and we can see that their income statement is for a 1-year period. That's generally the case, and it's for a period of time, not a point in time. A balance sheet is the point in time. It says that amounts are in millions. So what this means is in the most recent year, and I'll highlight this here, is Amazon a growing company, so I'll highlight sales here. In the most recent year, they had 574, and that's $1 billion worth of sales. The year before, 513 billion. 2 years ago, 469 billion. So they're absolutely a growing company. Is Amazon a profitable company? Well, to find that, we're going to look down at the bottom line at net income. Now, you can see that net income in this most recent year was $30 billion, and then the year before that, they actually had a loss, and then the year before that, they made money. They have an unusual accounts related to non-operating income and some investments that they have. But overall, yeah, Amazon is a fairly profitable company, and this past year, $30 billion of net income is one of the things that'll illustrate that. Now, cost of sales is certainly their biggest expense, as it is for a lot of companies, especially manufacturers and retailers. But we want to think about what else is a huge expense for them. It's fulfillment. Fulfilling these orders, $90 billion in order to fulfill the orders and basically get them all, properly delivered. A huge expense for Amazon and their delivery, but they still are profitable despite that big expense. Well, the operating cycle and the concepts of cash versus accrual accounting, companies need to have something to sell. So they oftentimes start by purchasing goods. And I'm just going to use this as kind of a manufacturer retailer. So they need to acquire goods somehow. So if it's a retailer like Amazon, they have to purchase some goods, and that's often done on account. And then they'll pay for those goods with cash. Could happen at the time that they purchase them, could happen sometimes later. Then they're going to sell the goods, often on account, and then after that, they're going to receive cash payment for those goods. And this cycle just continues. Purchase, pay, sell, and collect. Those are 4 different steps in the cycle. And where accounting can be important but also complex is when those steps don't happen at the same time. Is when the purchase and the payment don't happen at the same time, and when the sale and collection don't happen at the same time. That makes it more complex, as we'll see later on in this PowerPoint. Now, the cash versus the accrual basis. So the cash basis, this is not GAAP. This is not generally accepted accounting principles. We're going to record revenues when cash is received, expenses when cash is paid. The accrual basis is GAAP. Revenues are going to be recorded when they're earned, and expenses are going to be recorded when they're incurred. Certainly the cash basis would be more simple. It is subject to manipulation, however, and the accrual basis is going to better reflect the revenues that a company is going to have. It'll when we use accrual basis, it's going to create things like accounts receivable and accounts payable. Those would not be accounts that would be used really under the cash basis of accounting. So accrual basis is what we are going to focus on for companies that have to use GAAP. So again, these are publicly traded companies that are governed by the SEC, or these are companies that are trying to get loans from the banks. People as individuals, individuals are going to use cash basis of accounting, right? They're you and me in our personal lives are not subject to GAAP. Companies are. And accrual is also going to give rise to prepaid assets and unearned revenues. Well, accounts receivable and payable, I mentioned that these can be created, and we're going to see why those can be pretty significant. Let's look at Walmart and ExxonMobil. So Walmart's revenue, they're the only company in the world with more revenue than Amazon. That's probably going to change here. Within a couple of years, Amazon will take them over. My guess is probably by 2025 at the latest. And Walmart's revenue is $642 billion. ExxonMobil oil company, $345 billion. Walmart's accounts receivable are $9 billion. They don't sell a lot on account. ExxonMobil does. They have $38 billion. I think they're probably selling. I'd have to understand their business a little bit more, but maybe some of the independent-owned gas stations and such could be some of what happens there. Accounts payable, Walmart has a huge amount though, $57 billion. So when they're purchasing from their suppliers, in the last lesson we looked at Nike as an example. Walmart might purchase from Nike and not pay them right away, might take 30 days to pay them or something like that. That gives rise to accounts payable. ExxonMobil also has significant accounts payable, $58 billion. So a review question here, the cash basis of accounting. Which one of these is correct? Take a moment and look at it. Pause the video if you want, or just watch along. Record expenses when incurred? No. Expenses are recorded when paid. Revenues when earned? No. Revenues when the cash is received. Utilizes accounts receivable and prepaid expense accounts? Nope. That's going to be done under the accrual basis of accounting. And then records revenue when cash is received? Yes. Revenues when cash is received, expenses when cash is paid. So let's jump in a little bit more here and define revenues, expenses, and net income. So revenues, we're thinking of inflows of assets due to regular and ongoing transactions. You know, the most simple way to think about that is a company is selling products or services and they're ultimately going to get cash for it. Whether they get cash in advance or at the time of the sale or later, they're ultimately going to get some cash. That's the core concept of revenues. All right, but what it is the timing of when the cash is received is not going to dictate when they record the revenues. The revenues are going to be recorded when they're earned, which means goods are delivered, basically given to the customer, or the services are provided for their customer or for their client. It's usually going to be recorded along with cash if payment is made at the time of the revenue, or accounts receivable if payment is made after the goods are delivered or services are performed. Sometimes there's payments in advance. I think that's less common, but there could be payments in advance by customers, and at that point in time, a liability is going to be created, and then the actual performance of the revenue or the performing services delivering goods, that'll get rid of that liability. Now, Amazon, if we look at their sales revenues, everyone kind of thinks of their product sales, but they have Amazon Web Services with their cloud-based services, which is a very big and growing part of their company that way. If we're actually looking left to right on here, we can see their product sales are just going up by a little bit each year, and then their service sales are going up significantly. So a big part of that is Amazon Web Services. Well, the expenses, those are outflows of assets due to regular or ongoing transactions. So an activity that's going to cause us to end up using up our assets. These are tougher. Revenues, they're recorded when earned, which is goods delivered, services provided. That's usually, there's some complexities, but I think in theory, we can understand that. Someone gives us some services, we need to record some revenue. Someone gives us some goods. At that point in time, they're going to record revenue. But really, with expenses being recorded when incurred, when is the incurring of the expenses? They're usually going to be recorded with a cash payment at the time of the expense, or a liability if cash is going to be paid later. Sometimes if an expense is paid for in advance, then there's going to be an asset that's created. We're going to see that that's called prepaid expenses. Now, there's some specific requirements in order to record an expense. It has to be probable. Basically, that this expense is going to happen most often, that cash is going to be paid or need to be paid. You have to be able to estimate it. So this is certainly when cash is not paid at the time, but it is going to be paid in the future. It has to be probable you'll pay cash in the future. You have to be able to estimate it. Amazon's expenses, we could look at these here. Cost of sales. That's the big one. They purchase products, they resell them. It's when they resell the products that they're going to have cost of sales. Fulfillment, technology, infrastructure, sales, marketing, general and administrative expenses, right? Those are their big core expenses. And if we drilled a little bit further down, we'd see things like interest expense and income tax expense. Gains and losses, these are going to be less common. Revenue is an inflow of assets due to a normal and ongoing transaction. Gains are inflows of assets due to peripheral or occasional transactions. And then this one should actually say losses here. I will make sure to edit that, but that should say losses, outflow of assets due to a peripheral or occasional transaction. Again, that word right there should say losses. When you see the PowerPoint, that will be fixed. Because an expense is ongoing operations, losses is the occasional transactions. So we'll look at net income in the income statement right here, and we'll check out some subtotals as well. There's subtotals for gross margin, sales minus cost of sales. That is gross margin. Amazon doesn't actually choose to record choose to have that gross margin line. You don't have to. A lot of companies do, but you don't have to. Earnings before interest, taxes, depreciation, and amortization. That's you can see the letters are EBITDA. That's the abbreviation. In the business world, people will usually say EBITDA for that one. That's a common subtotal. It's used a little bit less in financial statements and more in discussions among people in the finance profession and people talking about investing decisions. That will subtract not just your cost of sales, but also your selling, general, and administrative. Operating income, EBIT, that'll subtract depreciation and amortization. So that is a subtotal that Walmart has. Most companies, manufacturing retailers, would probably show gross margin. Most would not necessarily show EBITDA in their income statement. They might discuss it in some of their reports, though. So operating income, most will show income before income taxes, subtract out interest expense, net of interest income, subtract out gains or losses. Most companies will show that one. We can see that Walmart has $37 billion of that. And then net income, that will subtract out taxes. And companies will show net income at the bottom. So this page is just meant to just say that the income statement has revenues, it has expenses, it has things like interest income, interest expense, gains and losses, but it also has a variety of subtotals. Now, if we're going to analyze an income statement, investors and creditors generally want cash, basically, as a return from their investments. And in the long run, net income and cash flows are going to be fairly similar. Increasing revenues will often lead to increasing income and cash flows. As long as we're selling at a price higher than our expenses are, that's going to help us get more income and cash flows. And also, when analyzing an income statement, expenses, we'll say, are they increasing more or less quickly than revenues? Hopefully they're increasing less quickly than revenues, but you just have to examine a company to determine for sure. And then look at net income. Is it increasing? And as I think about that, we've actually got it's lesson 12, which is a bunch of financial statement analysis using ratios. So we're going to dig into more details. These are just some quick things. Are we increasing revenues? How are expenses changing? Therefore, how is net income changing? That's at a very high level. Well, review question number 2. So order these accounts as they would appear on the income statement. I kind of did the first one there for you. Sales revenue is what goes on the income statement first. So look at the accounts on the left, which are alphabetized, and then put them in the order they would go on the income statement. Sales revenue comes in next. So look at the accounts. If you want to challenge yourself, you could pause it and try to see how you do. And then I will go ahead and unveil the results now. So after sales revenue, it's cost of sales. It's going to give us our first subtotal, which is gross margin. We'll then take out our general and administrative expenses, sometimes selling expenses in there as well, sometimes research and development expenses. That'll get us to our operating income. We'll then take out our interest expense. We'll factor in our gains and losses on the sale of assets. We'll get to income before taxes. Then we'll take out income tax expense to get down to net income. The only thing we didn't do here that we did on a previous slide is we didn't separately carve out depreciation and amortization. And that's because normally on a company's income statement, it doesn't separate those out. It doesn't have an EBITDA subtotal that I showed you a couple slides ago. But if a company is or investors are breaking that down behind the scenes, they might do that separately and compute that concept called EBITDA. All right, prepare journal entries for the income statement accounts. Let's get after it here. So the accounting equation, assets equals liabilities plus equity. That has to be in balance. We've known that assets will increase, we'll know that an increase in an asset is a debit, a decrease in an asset is a credit, and then for liabilities and equity, an increase in those accounts is a credit, a decrease in those accounts is a debit. You can see we're expanding equity a little bit down there. We didn't have that in lesson 2. And we can see that the debits are normally for dividends and losses and credits are for income. So certainly equity comes when owners make a contribution of cash to the company. We talked about that in lesson 2 with common stock, additional paid in capital, contributed capital, but those are more balance sheet transactions. The income is more of the income. The income statement, we're looking at income statement transactions here. So if a company has net income, there's going to ultimately be some sort of credit that rolls through into equity. And if they have a loss, it's going to be a debit that rolls through equity. We'll see even as we get into lesson 4 how those steps happen so that takes effect. Revenues increase with a credit, decrease with a debit. So we are rarely going to debit revenues. We'd have to have some sort of returns or something like that. And then expenses, we're going to increase with a debit. We're going to subtract with a credit. Similarly, we don't credit expenses very much. There'd have to be some sort of return or rebate or refund going on. All right, revenue example number 1. So this is a lot of the key of it. So let's say that a company provides $100 of services for cash. This is easy. Okay, this is the easy one. When you perform services, you record revenue. And it says they got cash at the time, so we debit cash and we credit service revenues. So that is the journal entry for this one. So when you provide services, whenever you see that term, you know you're going to credit revenue. And then it's just like, what happened in exchange? Here they got cash. Cash is an asset. So we're kind of doing our transaction analysis here to get that. Revenue example number 2, cash is collected after the sale. All right, so in this situation, a company provides 150 of services on account. Now, we look at that, and because they perform the services, we still want to record the revenue, but we can't also record cash. And we need at least one debit and one credit, so there's no cash, but someone owes us money because we gave them services and now they owe us money. So instead of a debit to cash, we're going to see debits to the account receivable asset and a credit to service revenues. And then when the company collects the services that they provided on account, okay, we think about what happens there. When they collect on that, they're collecting cash. So they're going to have some cash, and now their customer isn't going to owe them as much. So they're going to have less accounts receivable. So it's the collection of the services when you debit the cash and credit accounts receivable. The most common wrong answer would probably be that in that second example there, that a company collects for services provided on account. Someone might try to credit revenue there as an example. But no, the concept is the revenue is going to get credited when the services are provided, not when the cash is collected. Sometimes it happens at the same time. It oftentimes does. But if it doesn't, you still record the revenues when the services are provided. The third example here, what if cash is collected beforehand? It doesn't happen as much, but it certainly happens time to time when companies make deposits. There's sometimes the concept of a retainer when someone will pay in advance. So let's say a company collects cash for services to be provided in the future. Okay, they're going to debit cash, but the services aren't coming until the future. So it's like, what else do we do? Well, we have a liability to give services in the future. You know, the customer is going to want this. And in fact, if we don't give them services, they're going to demand their cash back, right? So we have a liability, and that's unearned revenues. Unearned revenues is a liability account. And then when they actually provide the services for the cash that's already been collected, there's no cash at that point in time. The cash is already done. Here they're just providing the services. So we know there's going to be revenue, and now we get rid of that liability. So we get rid of liabilities by debiting unearned revenues, which is a liability account, crediting service revenues. All right, expenses. So the revenues to me, if that, you might have to go back and watch that or think on that, but that's pretty boilerplate right there as far as you're getting cash at the time of the sale, after the sale, before the sale. Expenses can be a little bit trickier. We're still going to break it down into these same examples, but trying to understand when an expense is incurred is a little trickier of a concept. Well, the cash could be paid at the time of the expense. Maybe a company pays interest expense for $100 of cash. All right. So it had a loan from the bank and it has to pay the bank some interest, debit an expense, and credit cash. That one, most people can kind of understand that one. Now, let's say they're going to pay income taxes for $60 of cash. Okay, we're going to pay income tax expenses, so we're going to debit an income tax expense and we're going to credit cash. Most folks at some level are like, yep, I can see that. We're making a payment in exchange for interest or taxes. We debit an expense, we credit cash. Where it gets tougher is when cash is paid either after, in this example, or before the time of the expense. So let's say that a company incurs wages but doesn't yet pay them. So its employees do work, but they're not going to get paid for a couple weeks. And there's a little bit of a lag. And this is important when it crosses a year end. So maybe as of December 31st, the employees have done some work, but you're not going to pay them until early January. Well, you want to record the expense in the period that it relates to, that it was incurred. So if we incur wages, basically meaning people worked for our company, but we haven't yet paid them, we need to debit the expense in that period, but we can't credit cash because we didn't pay it. We credit a payable. We owe the employees money. And then in that later period, when we end up making payment, there's no more expense. We've already recorded the expense. Here's where we're going to get rid of the wages payable liability, and we're going to do so with cash. So that is cash paid after the expense. This is kind of the concept we're going to learn in lesson 4 of an accrued expense. This is a very common concept that you have an activity that is creating an expense before cash is paid. You're going to debit the expense, you're going to credit a liability, and then in the next period, you're going to debit the liability and credit cash. It's a very common thing. Example 3, cash is paid before the time of the expense. Again, this doesn't happen as often, but certainly does happen. Let's say a company pays in advance for next month's insurance. All right, so what's going to happen here is if this insurance is for next month, we're not going to debit insurance expense now because we haven't used it up. Okay, so instead we're going to debit prepaid insurance, which is an asset, and we're going to credit cash. So we're debiting prepaid insurance. Sometimes it's called prepaid insurance expense, but regardless, it's an asset, and credit the cash. And then next month, when that insurance is used up, all right, it's the activity, it's the using up of the insurance that is creating the expense, not the payment of cash. So when the insurance is used up, then we're going to debit the insurance expense and credit the prepaid insurance asset. So examples 2 and 3, these are definitely trickier and just have a lot of repetition until you kind of get them down. Now, a combined example, let's say a company purchases inventory on account. All right, well, they're going to debit inventory and credit accounts payable. Okay, they didn't pay cash for it. Now, it's important, inventory is an asset. This is not a cost of goods sold yet. They have not actually sold these goods. They still have an inventory asset. The company has something sitting on their shelves. Now they turn around and sell this inventory for cash. And this one is now a 2-part entry because 2 things have happened. We've got cash, and when at the time of a sale, we credit sales revenue, which is a revenue account. But you know what? We don't have the inventory anymore. So when we don't have the inventory, that's when we record the expense related to the inventory, which is called cost of goods sold. Cost of goods sold is usually the first expense on the income statement right after sales revenue. Sometimes it's cost of sales. Sometimes it's called cost of product sold. It's the first expense right after sales revenue. And then we also credit the inventory, the asset. It's gone. We don't have it anymore. The company then maybe has enough cash so it can actually pay off its purchases on account. So we're going back to that kind of that first entry where they purchased inventory on account. Maybe they didn't have cash to pay for it. Now they do have cash to pay for it. So now they're getting rid of the accounts payable liability by debiting in it, and they're getting rid of the cash by crediting that asset. So if we look at this review question here, if cash is collected before a company delivers goods, which account would be utilized? So this is the company that's ultimately going to be selling the goods, not purchasing the good. But if the cash is collected before the goods are delivered, what account are they going to utilize? What do you think? Well, it's not accounts receivable. That's when you deliver the goods and you're going to get paid later. It's not an accrued liability like wages payable or something. That's when there is an expense first that's going to be paid later. It's not a prepaid expense. That's going to be when the company pays cash before an expense incurs. But if you get paid before you deliver the goods, that's called an unearned revenue. You're going to debit cash and you're going to credit unearned revenues. Well, preparing an income statement and computing earnings per share, the first thing that we need to do is prepare what's called the T accounts. We looked at those before. Debit's always on the left, credit's always on the right. Sum them up. Whereas in the balance sheet, we oftentimes have debits and credits in the same accounts. Cash is increased for debits and decreased for credits. On the balance sheets, and then like inventory, when you buy it, will be a debit. When you sell it, will be a credit. On the income statement side of things, it's usually just on the one side. So revenues, you're almost always just going to see credits. Expenses, you're almost always just going to see debits. There can be, again, some occasional returns, but it's usually going to be where the entries are on the one side. So we've populated this for the example that we went through. So again, we went through an example of a lot of different transactions. This company has sold 3 items. They've provided provided 3 services. They've sold some items. They had some cost of goods sold. They had some wages expense, insurance expense, interest expense, income tax expense. We're basically building on the journal entries that we did earlier in this PowerPoint, putting all the debits on the left, credits on the right, summing them up, and now we can use that to prepare the income statement. We summed it up and we saw that we had $450 of service revenue, $500 of sales revenue. That gives us $950 of total revenue. Cost of goods sold is $300. Gross margin would then be $650. I'm just taking the balances on the T account on that previous slide. Wages expense $250, insurance of $110. That gets us down then to operating income of $290. We're going to reduce that by interest expense that we had of $100, gets us down to income before income taxes of $190. Reduce it by income tax expense of $60, going to get us to net income of $130. So again, you go from the journal entries to the T accounts to the income statement. And then the final thing we do is compute earnings per share. And that's just to make this more meaningful, because if we just tell people what our total net income was, that might be confusing to them, because they're like, well, I don't own the whole company. I only own a few shares. What is my share of that net income? We need to take the net income and divide it by the shares outstanding.